Are you struggling to invest in property this year and need help buying? Then you need to book in a consultation with Investor's Dream and let us do the hard work for you. Don't fall victim to missing out on incredible deals like everyone else. Lock in a meeting today. Go to investorsdream.com.au and secure your financial freedom today.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Hey everyone, how you going? Welcome to the show. Thanks for joining us as we navigate property markets right across the nation in what is some people are calling the biggest bull run in property for many years. I'm not going to go into it today. I think we're all pretty clear of what's going on. No doubt you're all connected in with smartpropertyinvestment.com.au, and that's where you get your info to help make more informed investing decisions. If you're not doing that, go and check it out. Every single day, and plenty of articles, information, analysis, interpretation of property markets, whether it's the macroeconomic factors which are shaping the investment asset class of property, all the way down through to where, how, when, what, and the considerations of buying property in markets right across Australia, whether it's at a suburb level or regional level, even a state-based level. Plenty of info all in one spot. But what I want to do today was actually go behind some of the headlines on smartpropertyinvestment.com.au over the last week or so to give some deeper interpretation and insights of it from those people who I'd like to think know a lot more about it than I do, who are working in property day in, day out with clients, but also on the front line with real estate agents and other people who are part of that buying process. Steve Waters and Victor Kumar join me in the studio. They're directors at Right Property Group, good friends of the Smart Property Investment Show. We've known them for many, many years. And you might have heard Steve recently joining me on our portfolio update, where we talk about the Smart Property Investment portfolio. If you haven't yet listened to that, go and check it out. Really good deep dive into the capital growth side of the Smart Property Investment portfolio. And stay tuned over the next couple of months. We're going to get into some of the cash flow position of it and the P&L level and all that sort of stuff as well. So stand by. But gents, how you going?
Yeah, going well, mate.
Good?
How are you?
Good. Now, I know, Victor, the first thing you read every single morning and the last thing you read before you go to bed every night is Smart Property Investment to make sure you're more informed of what's going on in property.
Doesn't everybody?
Doesn't everybody? No, but it's a couple of articles which I've pulled out that I really want to get into while I've got you guys here in the studio to give some sense to it. And I'm conscious that we write the headlines, we write the stories. So therefore, you know, there is some bias in some degree because of what we just choose to cover is what people choose to write. So we're obviously invested in these particular stories. There is literally, you know, press releases flooding through our door any given day, data coming through our door any given day. So sometimes it's a challenge to work out what we do write about or what is the most relevant topics to cover. So here's a couple of headlines I want to go through, get your sense of it, and also Steve's. First story here, smartpropertyinvestment.com.au. House prices to grow by 25% over 3 years. A quick synopsis of this. New research is predicting a large gain in property prices of around 25% through to the end of 2023, driven mainly by low interest rates. Using the Reserve Bank of Australia's model of the housing market, Coolabah Capital Investments, CCI, is predicting substantial property price growth through to the end of 2023, as well as similar gains in real residential investment. Now, I don't want to be too much behind this bandwagon of everyone talking about the market. Everyone's going nuts, 25% in 3 years, which sounds pretty good. What are you seeing? Is this going to happen?
Look, if the current trend continues, more than likely. But this is, again, a trend that is changing day by day. And it has got several different factors influencing it. And the main thing would be finance and also the appetite for people to get into investments, which will continue this trend, right? So if that changes, this prediction will change. I mean, we only need to go back to 2020 where everyone was predicting a 30% decline. But that trend changed really quickly. And now we're talking a bull run and a good increase. So there are many factors that govern it, but as the current trend is showing, it is on the upward trajectory.
The question I ask around this is that everyone's talking about positive price growth, right? But it's from when? So we all know we've been in this market for a little while. There's been a period of, in some places, negative growth. So is this just a recalibration of prices post the pandemic? And this article here on smartpropertyinvestment.com.au, Steve, the piece here which I'll pull out, according to CCI's modelling in real terms, national house prices are currently up about 6% from prior to the pandemic, which contrasts with past recessions where the median peak to trough decline has been 15%. Even during the financial crisis, which the RBI classes a brief slowdown rather than a recession, real house prices fell by 9%. There's a quote here: the resilience of prices during the pandemic stands as testament to an aggressive and generally unprecedented fiscal and monetary policy response across the advanced economies, with a critical role played by job retention schemes. So there's been a lot of government stimulus to try and support how prices have gone post the pandemic. But are prices back to where they were 3 years ago, or have you actually seen real price growth on this?
No, we've seen real price growth. It's very easy to say, the market is going to grow by whatever it was, 25%, but which part of the market? Because we have a very big disconnect between attached and detached dwellings at this point in time, more so than we ever have. And so there are some markets that have contracted, being in the attached subpar, subgrade unit market, which has affected the averages. And I suspect that they'll probably go sideways until the international borders open, which therefore means that the suburbs, as an example, will actually do better than 25% if we go off this modelling. Do I think we've had it? Absolutely. Back 3 years ago, I know of plenty of areas that were still going up. So we've actually had growth on top of growth, or we've had growth on top of a market that didn't contract, but it just didn't do anything. So limited growth. Yeah. Whether it happens or not, well, there's a lot of underlying components of which we've never seen before. The monetary policy that we have, the grants, home builder, JobKeeper, you name it, the cost of money, COVID. These are all pieces to the pie of which we have never seen before. So it's very easy to start, well, it's not easy, but I'll say it, to start modelling what the potential could be. And my guess is that there's a very good chance it will become self-fulfilling.
Yeah. And it's a self-fulfilling sort of prophecy around price growth that's happened in other markets, Victor. But a lot of people would, if you're new to this game, assume that there's been no growth over the last sort of 3 to 4 years. And the growth is now happening now. Some of it's pepped up demand. Some of it is as a result of some of the factors shaping monetary policy or lending, etc. But even during COVID and prior to COVID, there were some markets which were growing.
Absolutely, they were.
Really well, and often not talked about. It's like, oh no, now there's growth.
Yeah, I think we're looking at it from average figure point of view and lumping everything together. And like you said, Steve, there's a big disconnect between detached and attached dwellings. And that could become the second run when houses become unaffordable. Now, it's not unaffordable from a point of view of the first home buyer trying to get in the market and they can't afford the repayments. It's unaffordable from a deposit point of view. They can't save up the deposit in time. So they've got the bank of mum and dad helping and all that, and that will continue that trend. People are getting into more houses, but we're starting to see snippets of, okay, maybe not. Let's sit it out. It's going too fast. And the natural reset may be at some point in time. Personally, I think it'd probably be in about 1-2 years' time when we're talking about, hang on, the units are looking really good. The fundamental units are looking really good. They're providing much better value than detached.
As long as they're in the correct space. But I think you also mentioned the bank of mum and dad. I think that'll become more of a component, if you will.
Well, it needs to be, because I saw some numbers coming out, and I'm probably going to get these wrong, but it's taken people like 7 years to be able to save a deposit.
Yeah, and if they get rid of the homeowner grants, well, that'll just accentuate the problem as well. But I think that in terms of the growth, I can remember like it was yesterday, the federal election from a couple of years ago. Yeah. And I know of areas throughout, let's say Sydney, because that's where we're recording today, that had immediate growth, and that growth didn't stop all the way up until today. So from the federal election through, it's still growing. So the whole narrative around we had sideways growth or a contraction in some areas just wasn't true.
So can you give me some sense, Steve, because for those less sophisticated or new investors, they don't really understand the relationship between capital growth and yield. Two different things. So the property going up in value and then the money you generate from the rent of holding that investment property is a really important piece here. And I'd like to get your interpretation of it. We're talking about sort of 25% growth by the end of 2023. So from today, that's fine. But while a similar growth trajectory is expected across residential investment, with CCI predicting 25% lift over 3 years, rents are tipped to drop by 2% through the end of 2023 as vacancy rates peak. So capital growth and increase in your rent there is not a correlation between growth between the two of them.
No.
And it's normally act and operate at different sort of...
Historically, there is, but we're in a different time this cycle, being that there are large parts of Australia that are undersupplied in terms of accommodation. And so that's just supply and demand that will start to work. And in fact, we've already seen that in a lot of areas where rents have gone up by double-digit growth over the last 12 months and I believe will continue to do so. However, there will become a point in time in some areas where the growth has been so strong that the yield it represents, because the rents haven't moved in line with that, will start to get smaller and smaller and smaller. And so the commercial aspect of investing in property will then come to the front of mind, saying, well, is this where my money's going to work best for me? Taking into account there's very skinny cash flow. Where else can I go? So there'll be that natural tipping point. In terms of rents dropping, well, yeah, it depends. Depends where. Once again, if we go back to the subpar or poor grade attached unit dwellings throughout some of the CBDs, in particular Melbourne and Sydney, absolutely. I think that there's more hurt to come until those borders open up.
Yeah, and it's funny how the stories we write and the information coming out, there's another piece here. It's connected in with this price growth, Vic, on smartproinvestment.com.au. Aussies increasingly fearful of a property boom. So on one hand, we're talking about, hey, isn't it great to get 25% price growth? And I'm sure there is parts of the Australian public who go, happy days, that's good. But then on the other hand, Aussies increasingly fearful of a property boom. I'll read out the first couple of sentences, Vic. While consumer confidence is at 11-year high, Aussies are increasingly fearful of property boom with expectations of further price increases at the highest level since December 23. In fact, according to Westpac's latest consumer sentiment survey, the time to buy a dwelling index decreased 7.9% from 116.4 points in March to 107.2 in April, and is now 18.8% below the peak in November. So there's a two-speed economy here. Oh, everyone, property prices are growing. Oh, but that's not good.
Yeah, I don't buy into that, because it wasn't too long ago that index was extremely high, as you pointed out. However, the decline in that index actually is in line with the narrative over the last, let's call it 6 to 8 weeks, around interest rates are going to increase, APRA is going to pull the handbrake.
Yeah.
And so all of that in our subconscious, people are going, well, maybe we've seen the peak, maybe interest rates are going to go up, should I not buy now?
Yeah.
And I'll guarantee that index will be different in another month.
It will. And this is the cyclical nature of this. You've seen it 1,000 times, Victor. When investors are happy, your first-home buyers and owner occupiers aren't happy because they're talking about the affordability problem.
Correct. And there are a couple of factors playing in here, right? One is the convenience factor, right? I want my weekends back. So let's sit this one as, let's continue renting, because I'm competing against 100 people at an open home and I'm not even getting a foot in.
That's on a good day. It's only 100 people there.
That's right. So they look at that and say, maybe we need to wait until the market cools off. Whilst our savings much higher in terms of what we're able to save from a household point of view, because we can't travel outside of Australia, apart from New Zealand now. However, they're not able to save as much because the prices keep moving up, right? So hence the fear that we are going to miss out, and it becomes a bit of an apathy where they're saying, I can't do it. I can't get my foot in the door. I can't save enough money. I'm always losing out when I'm trying to go to an auction or when I'm trying to buy a property. Then you get all these headlines where it's gone 100,000, 200,000 above reserve. And people are thinking, it's too competitive. I'll sit this one out.
Yeah, I'd suggest that we're going to start to see a lot more narrative around rent vesting once again, and that people will make the choice to rent vest, just as it did the last cycle. Because you're right, it's very hard to get in on that market if you're looking for the forever home.
That's how you can play the affordability game, right? You might not be able to buy where you want to live. However, you can still be investing into the asset class of property by investing where you can afford.
Or whatever the asset may be. It's just making that money work for you. And I think we're almost at that tipping point where...
Well, they were saying through
you're gonna
COVID
see
that
large
property,
numbers.
you saw that whole affordability narrative change during COVID, where people are going, it's the most affordable time to ever buy a property. When banks were talking about 30% reductions, everyone's coming out of woodworks going, what a great time to be buying property.
Yeah.
Like, we're literally only a year later.
I know. And so when you read these reports and all these stories about these prophecies around price growth, we only got to go back 8 months ago where it was completely left, 30% losses. So I don't know, do people start to say, well, okay, where's the credibility in your forecasting?
I don't. If you look at credibility forecasting, to my point, there was 2 or 3 of the major banks got their predictions completely wrong.
Very wrong. Look, I don't think
Completely
you
wrong.
could have been more wrong.
You know, that's when people sat with their heads in their hands thinking the world is nigh, right? When banks, probably a year ago to today, Commonwealth Bank, I think, 30% reduction in prices, capital value. Like all Australians went, shit, I'm poor.
Well, we saw 30, then 20, then 10, and then I think we saw 5 and then 7% growth.
Now they're talking about 25% growth in 3 years.
Yeah.
But, were they completely wrong, or were they just using a trajectory of the data to say, well, that's where it's heading, right? If nothing else changes, that's where it's going to go. But things changed. Sentiments changed. So therefore, the trajectory changed. See, I have a problem pronouncing that word as well.
Trajectory. There you go.
Trajectory.
Trajectory.
So if that changes, the outcome, the end result will change. So the predictions will change.
Do you know where I think they got it wrong? Is I think that because for us, it was completely obvious that it wasn't going to go down that path. And we were very public about it. Yeah. But where I think they got it wrong is they didn't give enough credit to Mr. and Mrs. Smith, to the consumer, and their ability to make educated decisions and their just the sophistication to be able to make the right decisions. I think they thought that everybody was going to capitulate between their ears and have this negative mindset, which then would drive them up. But I think the consumer said, you know what, just like they did with the election, saying, you know what, this is not going to happen. You know, we're far more entrepreneurial today and our understanding of different asset classes is amplified.
And I think what happened, to your point, Victor, was government intervention. So they thought there's so many Australians who are redlining in terms of home ownership and their debt levels against it, that everyone's going to start offloading property because everyone's not going to have a job and people are going to be financial stress, et cetera, et cetera. And that just didn't happen. The people most impacted by the COVID-19 pandemic in those industries weren't largely homeowners and property investors. They were people working in hospitality and more the renters. So hence the reason why they put moratorium on rents. But they got that completely wrong. I thought the banks probably thought that every Australian's going to be selling their properties, therefore it's going to be a huge run on property.
Well, that's why there was the mortgage moratorium, and I don't, in combination with record levels of people in front of their mortgages, thanks to offset facilities and the like, bought time.
And now that it's completely the opposite. This Australians have more savings than any time in history.
Well, this is the whole point going, what I made earlier on about just the levels of sophistication today. I don't think the banks and the economists and whoever didn't give enough credit for.
And I think I saw that you probably guys, I hope would agree with this, is that Australians grew up a lot in the GFC. Like a lot of Australians started to take a lot more responsibility for their own finances. Where prior to that, they were like, I don't know, I just put my money in my super and,
Look, I think the information age has also helped quite a bit.
True.
Media articles, SBI, for that matter, they have helped keep people informed. So if we compare that to the GFC, where there was less immediate information flowing around, to compare to now, people are able to decipher, okay, what's the movement in the market? What's the sentiment? And that kept people informed, and they were able to make good financial decisions going forward.
Yeah, that's well put. Stay with us. We're going to go a break. When we come back, we're going to get the government interpretation of this back in a moment.
Whether you're a seasoned property investor or about to buy your first property, finding the right investment property to buy in 2021 isn't easy. Why do it alone when you could partner with award-winning buyer's agent Paul Glossop? Over the last 10 years, Paul has helped hundreds of clients build multi-property portfolios. Paul's secret is finding off-market bargains that get snapped up before the general public even gets a sniff. Interested? Head to purepropertyinvestment.com today to schedule a strategy call with Paul Glossop.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Steve Waters and Victor Kumar from the Right Property Group, going through some of the headlines shaping property at the moment. Now, we had a good discussion around before the break, 25% increase in property, and then the dichotomy of that, people complaining about a property boom and how they don't want it. So it depends where you sit, what side of the fence, what your view is. However, Vic, the government seems pretty satisfied with the direction of the property markets at the moment. And we now know, and we have seen just recently, that the government will intervene if they're not happy with the trajectory of property prices in Australia. We only need to go back, and we spoke about it a lot over many years, levers and buttons they can pull and push to help change the speed of growth, whether it's APRA getting involved around capping investment lending and all this sort of stuff. It's a story here on smartpropertyinvestment.com.au. Victor, government pleased with property price growth. The government said is not concerned about the RBA's warning that the financial system could be rocked if there's a debt blowout. In fact, it is very pleased that confidence levels are leading to a strong housing market. There's a quote here from the RBA. Even if lenders do weaken their own settings, increase risk-taking by optimistic borrowers could see a deterioration in the average quality of new lending. This would weaken the resilience of businesses and households and the financial system to future shocks. That's what the RBA said. The Assistant Treasurer and Minister for Housing, Michael Zucker, he told the media that not only is the government not worried, he's very pleased. He's got a quote here, Vic. From our perspective, we are very pleased that confidence levels in the strength of the economy and the unemployment rate is leading to a strong housing market where first-time buyers are at 15-year highs when occupiers in a very dominant position in the housing market. So he told that to Sky News. So the government sounds like they're not going to intervene too much. The RBA said we're going to have low interest rates for the period ahead, and the government's going to let this run, right?
Yeah. Question. Is there an election coming on soon?
It could be.
So that is part of, without being political, one of the things is parties don't mess around with property and tax just pre-election. I mean, if they do, they get annihilated at the elections. So that's one factor. The other factor is that if you look at how the market is performing, the whole basis of the economy is largely underpinned by confidence in property. So if we are looking for our economy to recover strongly ahead of other countries, other developed countries, we want to throw our support behind property because there's a lot of flow-on transactions that happen. If you look at the incentives that are thrown into the property market, it wasn't just stabilizing businesses and employment. They threw a lot of money into the property industry. This is the government to help stabilize everything during COVID.
What happens, Steve, if Australians feel wealthier in their property? What's the net result of that?
You're referring to the wealth effect because let's not forget that indirectly, the property industry is responsible for about 1 in 10 jobs. That's a big portion.
Is it that much, is it?
Yeah. Indirectly and directly. Think about it, the Harvey Norman, white goods, the transport guy, and so on. But the wealth effect is very important. That's why the government's pleased with the way that the markets are going, because the more something's worth when you own it, the better you feel, the more inclined you are to spend. And that makes the economy percolate. Yeah. And so I would imagine that they are very, very happy.
So it's the connected, I guess, spending of Australians if they've got more money or their property's going up in value. So more equity, what do? They refinance. What do they do if they refinance? They buy a flat screen TV, they buy a new car, they buy whatever.
They go out to dinner more often.
And
this is the wealth effect. It's such an important part of the economy, and clearly they understand that, and that's why they're trying to perpetuate it.
Yeah, and both at federal and state level, the governments generate a fair degree of income out of property transactions. So they want property to transact, particularly the states, in terms of stamp duty, right?
Well, even with some of the changes.
Third of their revenue.
Correct. So there's a much larger picture here than whether the houses are going up too quickly or not for the immediate term. Yeah. I think it's more, we'll deal with that problem later.
Yeah, and the government will deal with the problem if they think it gets too far out of hand. We need to go back, 2016 when the APRA requirements come in. That was the idea of saying, hey, there's too many property investors in the market shaping affordability for other Australians. We need to put a handbrake on.
But it's different this time because it's not the investors that are driving the market. It's the homeowner, the upsizer, downsizer, first homeowner. And let's not forget, we are in the position that we are today being remarkably undersupplied throughout a lot of the sectors because of that very APRA handbrake that was pulled back in 16-17.
There's a piece here, but despite the minister's confidence, market pundits have said that the RBA and APRA, so that's a prudential regulator, should start tapping the lending standards brake in the months ahead. In a recent market outlook, AMB Capital's chief economist Shane Oliver, good economist, predicted that in the absence of intervention and given current market conditions, property price growth could run for another 18 months with house prices surging 20% or so. That's cool. It's a quote here. While they don't target house prices, past experience indicates that surging house prices lead to a deterioration in lending standards and increasing financial stability risks, right? So this is like, the money is cheap at the moment and banks want to lend money because if banks lend money, they make more money and they can deliver more money to their shareholders and stuff like that. So it's a cyclical type of thing, right? How long are they going to let it run before we do get some intervention? Or do you think it'll patter itself out and self-stabilise?
I think it could go either direction. There will be intervention or they'll just let it run its natural course. But let's not also forget that the Australian banking system and ecosystem is one of the strongest and most heavily regulated in the world.
Yep.
We're in good shape.
Our banks are strong. We just don't have one strong bank. We've got
We've got
many,
multiple. Yeah. And we don't have a scenario where, if someone goes up to the bank and says, I want to borrow some money, and there's no intervention, there's no checks and measures like there are in some other parts of the world. We're a strong system, and I think let the market do what the market does without too much intervention. How long before intervention comes along? Anybody's guess.
Yeah, and Vic, in terms of access to mortgages compared to, got pretty hard for investors. It's still not easy for investors, but some of those standards are softening a little bit.
They're definitely softening. However, one of the things that we need to be mindful when we compare ourselves to the others is that we don't have non-recourse loans. In other words, if you're not able to make repayments, you're still responsible for it even after the bank sells from under you. So people do take a cautious approach to lending. Now, if anything, they are pushing themselves in terms of limit because the rates are relatively cheap. And if you look at the previous headline, in terms of people are starting to say, okay, we might want to sit this one out, it's more so to do with there's more now talks of perhaps an interest rate rise, right? And they're thinking, hang on, if I'm trying to get into property and it's absolutely my maximum limit, if there is going to be an interest rise, maybe I can't afford it. So there is still a lot of responsible lending in place. But more so, I think people are starting to do their figures and look at their affordability, their employment and so forth, and perhaps becoming a little bit more responsible borrowers as such as well.
That's an interesting position because the more someone is confident in their own unique circumstances, the more their risk profile elevates.
Yeah.
And that's where you get that tipping point somewhere in the future.
So what's all this mean for property investors, Victor?
Look, we still need to look at it from a medium to long term, right? Don't look at the immediate trend and say, yes, it'll go up 23%. Each property that you buy, you need to look at it from a viewpoint of what will it do for me? And look at the worst case scenario. Let's say the 23% increase does not come into play. And that's the whole reason you bought into it. Maybe that's not the right choice. However, you need to be looking at it from a viewpoint of when's the best time to invest? Probably 10 years ago. When's the next best time? When you can afford to.
Yeah, so now.
Now, if you can afford to, yes, now. But take a medium to long-term approach. Don't chase the immediate wins.
And, okay, to that point, taking a medium to long-term approach, it's not a bad asset class to back.
No, you get good leverage. You're able to enhance the value in the right areas, and you've got the income to support it via the rentals.
Yeah, and that makes property largely unique as an investment class. That's why you love property, Steve, isn't it?
That's a flight to safety. Yeah. And it's a tangible asset, and everybody needs a roof over their head, as the expression goes.
Yeah.
But Victor's correct. Like, look at it from a long-term point of view. If you're on the edge of not being able to afford it today, then don't do it because it's not going to get any better in terms of affordability.
And this comes down to you've got to be responsible for yourself. Just because a bank says it will lend you money doesn't necessarily mean you should borrow the maximum amount they're going to give you.
Well, there's two types of affordability. One is what the bank tells you can afford, and one that you know that you can afford. And sometimes they are wildly different.
Yeah. So you've got to be true to yourself. Okay, good. We'll cover a lot more of that stuff moving forward. smartpropertyinvestment.com. We'll go to another break. When we come back, Metro Melbourne, Victor, surpasses $1 million for the first time. Back in a moment.
Are you ready to take your first steps towards financial freedom by investing in property? Maybe you've started your portfolio but need some help continuing to grow. Lachlan Vidler and the team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take advantage of some of the best investing conditions in almost 20 years. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment and set you on your path to financial freedom. Book in your free discovery call today at atlaspropertygroup.com.au.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show. Hope you're enjoying our discussion with Steve Waters and Victor Kumar, their directors of the Rock Property Group, going behind the headlines right now on smartpropertyinvestment.com.au. Victor, I know you love buying Metro Melbourne apartments.
Especially in Docklands.
Especially in Docklands.
No, I don't.
Now surpassed $1 million for the first time. I guess two things here we can have a chat about. And this is the Real Estate Institute of Victoria has flagged one of the largest quarterly increases in the state in the March 2021 quarter. According to REIV data, house prices in metropolitan Melbourne have soared 8.8% to the median of just over $1 million, the highest quarterly increase in 12 years. For the first time, that area surpassed $1 million mark. So houses versus units. So a lot of units in the sort of inner ring of Melbourne. And at different times in history, there's been an oversupply and there's been an undersupply of those units. And this is just going to be the same discussion every 5 to 10 years about what's going on. If you buy at the right time, you do well. If you buy at the wrong time, you won't do so well. And then sometimes you've got to factor in the fact that you get global pandemics. And the people who traditionally would be renting those apartments probably aren't here right now. So there's a double whammy and definitely a two-speed market in most capital cities at the moment. Melbourne inner ring properties, $1 million. I'd expect that to have happened at some point in time.
Yep. And if you look at the property market in itself, right, they're the two leaders of the property market, Sydney and Melbourne.
Yeah.
And Melbourne had the misfortune of rolling lockdowns. So they're quite out of step with where the Sydney market is. And therefore, we are now trying to play catch up. And people, when they've come out of lockdown, all of a sudden, they're trying to catch up to where they wanted to be in terms of their investments, in terms of their own occupier property and so forth. And certainly coming back to affordability and the ability to buy, being able to actually get a loan as opposed to back in 2019 where you would have struggled to get a loan at that point in time. It just puts people in the box seat. The confidence in terms of employment is certainly there. And if you look at it from a movement of population, people are starting to get into this lifestyle, cafe lifestyle, or sea change, or even getting closer to where they wanted to be, because now they've got the savings behind them, they've got the affordability, and naturally there is a push in terms of differential between supply and demand. And but the natural consequence is that we're getting a bull run or a strong run in terms of growth from a quarter-to-quarter perspective.
Yeah, and reading this story on cyprinvestment.com, go and check it out. Metro Melbourne surpassed 1 million mark for the first time. That's just one component of this story. By reading this story, I would say the whole Victorian market is pretty strong. And some quotes here. Apart from families looking the opportunity to upgrade their home as they come out of intensive lockdowns, the price growth was also boosted by incentives for first-home buyers, mortgage repayment holidays, low interest rates. And that's a quote from the REIV president, Leah Kalnin, who I spoke to a couple of times during the course of their lockdown. You go and listen to those discussions. Inner and Middle Melbourne joins Metro Melbourne, a $1 million club with median prices sitting at 1.5.
Look, there is another catalyst there, Phil, which is their stamp duty concessions at the moment.
Absolutely.
So if you're buying an established property up to $1 million, you get 25% discount on your stamp duty, even if it's an established property and even if it's an investment. So naturally, the ability for people to, from a cost point of view, to get into property now, as opposed to having to save up a bit more.
And this might shape your timing of the market.
What the anomaly in that market is that it's not being investor driven. It's more around the homeowner.
Yeah.
Because the investors are still a little shy from that commercial aspect. In other words, what it produces in its yield compared to other areas. And also, to be fair to Melbourne, with the catch up, if you will, is that they haven't had the media attention that, say, Sydney and to a degree Brisbane have had. Now they're going to get it. And I would suggest that once the borders open, and even before that, when the investors see the growth patterns in there, because human nature is they want to see the result before they get in, it'll probably amplify.
Well, they're saying it's regional Victoria broke records also in March quarter. House prices rising 4.1% to a median over $500,000 first time. It's surpassed that. Mrs. Callan expressed her optimism about the growth in property in Victoria as activity returns. To your point, even unit prices are going up here. Are you guys active down there now? You're looking. Where do you like? What do you like? What can you tell us? What sort of secrets you got, Stephen?
The secrets. It's look, I like the suburbs.
Yeah.
I like with the land component.
Not too far out?
I don't mind being within a commutable distance back to the CBD.
Yeah.
And that's unique to everybody, but circa an hour or thereabouts.
Yeah.
I'm not too buoyant for the long term on some of the other regional areas where if there is a shift back to the work office environment, that you'll start to see a shift from the coastal areas or the regional areas back towards the commutable distances from the CBD. So we may see some data in the coming years that we've shown amplified growth, but then we'll see a contraction as people move back.
That's like the Mornington Peninsula, right? Every man and his dog's down there now. But
if you can, it's like any area throughout Australia like that. If you have the ability, because you're in, I don't know, this tech space, and thanks to technology, you can work from wherever. That's great. Byron Bay is an example. But what about if you're not? And what about if you're called back to the office? So it's more about the longevity for me. Do I think there's immediate upside? Clearly there is. Medium term, probably. I'm just not so sure about the long term.
Yeah. Okay. So would you be in Melbourne over Sydney or Brisbane, Victor, is the question.
I think the question is, what does your portfolio need? It's not about where, it's the outcome of
You've got
the
a
property.
career in politics coming your way. That's a very
Absolutely.
diplomatic answer.
There's an election coming up, isn't there?
But say you're a new investor and you've got one property or your first property.
Yep.
Melbourne over Brizzy?
Look, again, it comes back to
What you're trying to
understanding the
achieve.
growth patterns in each state, and also what you need. Do you need the cash flow, or can you sacrifice a little bit of the cash flow and get into more of the stronger immediate growth, right? And that would ultimately drive your foundational portfolio.
What are you seeing in Brizzy at the moment, Steve?
It's very strong.
Yeah.
Yeah. There's
What sort of areas? All of Brizzy?
just about all of it. Yeah.
As long as it's not flood prone.
Well, even the flood prone stuff is doing, because people are starting to, as I keep talking about, sacrifice the non-negotiables.
Yeah.
One of those usual non-negotiables, power lines or floods, and people are just trying to get a piece of the market there. And so they're doing it. But they're very, very low on supply in terms of accommodation for rent. So we're seeing vacancy rates below 1% in a lot of areas.
Yeah.
Open homes are full. Stock on market is very, very skinny. Population growth as people leave the southern states for Brisbane, and jobs growth, as I think I just mentioned, that is very good as well. So it has all the ingredients
Finally.
in the
Where it should
pot.
happen.
And the growth there has been, over the last 12 months, has been stellar.
And they're saying in this piece here on Melbourne, auctions are more popular than private treaty. What's it like in Brizzy?
Auctions have become, I think they had their clearance rate on the weekend was 90%. Traditionally, Brisbane is not an auction-orientated state.
But it's shifting that way now.
Well, it is now, because the market is perpetuating at such a rate, and agents can't keep pace with the market, nor can the vendor.
Yeah.
Then overlay this whole underquoting scenario that fair trading departments are starting to always talk about and people whinge about. They say, okay, no problems, we'll put it to auction.
Yeah, it's a lot easier for agents. And I'd like to think most agents don't manipulate that. It's just a product of a rising market.
I would agree with you wholeheartedly. I don't think
There's
are
nothing
any agents.
really sinister there, because, you look at on the face of it, you're going to have people coming out for the auctions anyway. You don't need to be underquoting in order to stimulate that.
It distorts the data though as well, and the narrative around it, because there is nothing sinister there. The agents aren't underquoting to get you into the front door. There's enough people, they don't particularly need any more. Yeah. And what happens is when the data is scraped and it says a price or an expectation of 800,000 and it sells for $1 million, it actually shapes the narrative around that particular market and the price growth and days on market and everything like that. So once again, data is great directional, but understanding what's behind it is imperative.
It's not uncommon in a market like this to go above listed price, right? It sells. Normally, most properties would sell above listed price. And that's not because the agents have got it wrong. It's what the market's willing to pay, and there's competition there.
And you're not paying over market.
Yep.
It's just that's where the market is.
Well, the other side of the equation is, you may be paying, if you're financing a property, and most people have a mortgage against the property, not that many cash buyers out there, what you pay for it is what you're going to set your LVR against. So if you do overpay for a property based on what the banks think the valuation is, you might need to find more money. And this is a big problem that we're seeing at the moment.
This is why auctions are very scary.
Yeah.
I was speaking to probably 3 or 4 agents earlier this week, and they were saying that they're having constant problems with having to justify to the valuers the contract price. Now, these aren't our clients. These are just the general public, where they've gone to auction or they've bought it private treaty. The value has gone out there and they're not valuing it at contract price. Yeah. And they're having to work very hard to justify it. So the valuers are a little bit scared as well, on top of...
But that's just a product of timing. Eventually the banks will go...
The data's not there. There's no hardcore evidence because the market is perpetuating and they rely upon that evidence.
So you got to expect to either increase your LVR and pay some lender's mortgage insurance.
If you can,
or make sure you got some extra cash.
That you have the capital
for a deposit
that's sufficient enough to top it up, so to speak.
Cool. That's good, guys. I really enjoyed the chat. Good time to be in property investing, Vic?
Always a good time to be in property investing.
Yeah. You guys in buying at the moment? You're always active?
Trying to buy.
Yeah.
It's more to the
Personally?
point. Yeah.
Yeah.
It's, and for clients, clearly, because that's what we do.
That's what you do.
But personally, I know Vic's the same. Trying to get the finance, which is not as easy as everybody thinks, and also trying to get in front of the public
Yeah.
before the public is hard.
It's hard. It's podcast in itself how to go about doing it. But thanks for your time today, guys. Steve Waters and Victor Kumar, Right Property Group. Hope you enjoyed that, everyone. Big favour for me, please. It's just not myself here behind the microphone, a Smart Property Investment Show. There is big team who are the talent behind his operation who make me sound good and ensure that they get this podcast into your hands. So wherever you listen to this, if you can do me a big favour and leave a review, 5 stars if you think that's cool, whatever platform you listen to, they get a real kick out of it, and that'll be a real favour to me. Remember, smartpropertyinvestment.com.au, social media, Smart Property HQ for headquarters is where you'll find us. That's how you'd like to get your information. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.